Welcome to today's deep dive.
Yes.
I am so glad you're joining us for this one because we are looking at something that has just completely reshaped the way everyday people build wealth.
Oh, absolutely. It's a massive shift.
Right. Because think about this for a second. If you look back historically, getting access to private real estate deals, it basically required a country club membership.
Pretty much.
You needed to know the right developers. You had
Yeah.
to have this massive amount of capital just sitting around, and you had to be part of an exclusive inner circle just to even hear about the deals in the first place.
Let alone actually invest in them.
Exactly.
Mhm.
But today, it is a completely different world. You literally just need a smartphone in your hand and like $10 in your bank account to get started.
It really is a profound shift in access. I mean, it's night and day. But I think we need to establish a very clear boundary right from the start here.
Okay, lay it on us.
Democratized access does not equal democratized returns.
Oof. Yeah, that's the hard truth.
Right. Just because you can download an app while you're drinking your morning coffee and buy into a commercial real estate portfolio, that does not mean you are guaranteed the same outcomes as the big institutional investors.
Because the mechanics behind the scenes are different.
Completely different. How your money is handled, how it's taxed, and most importantly, how you are charged. The fees are drastically different when you come in through a retail platform.
And that central tension right there, that is exactly why we are here today. For this deep dive, we are pulling from this massive, really comprehensive analysis from the Daily Fiscal.
It's an incredible report.
It really is. They meticulously tracked alternative asset platforms all the way back to 2019. And for this specific report, they analyzed the deal documents of over 45 individual real estate crowdfunding offerings.
Which is a ton of paperwork to dig through.
A completely staggering amount of fine print. So
Yeah.
our mission today is to cut right through the glossy marketing pages. We want to put two of the absolute biggest players head-to-head, Fundrise and RealtyMogul.
And honestly, it is the perfect time for this comparison.
Why right now?
Well, to truly understand what is at stake for your portfolio today, we have to look at the broader macroeconomic landscape. We all saw the absolute bloodbath that happened during the 2024 and 2025 interest rate environment.
Oh, man. Yeah. Commercial real estate was just battered.
Battered is the right word. But to understand why it got battered, you have to look at how these massive buildings are actually financed.
Right, because I think a lot of people just assume it's like a 30-year fixed mortgage on a residential house. But it's not, is it?
Far from it. Commercial real estate is heavily reliant on much shorter-term loans. You're usually looking at 5 to 10 years. And a lot of them have variable interest rates.
Okay, so paint a picture of what that looks like in the real world.
Okay, so imagine a developer bought this massive apartment complex in 2021.
When money was practically free.
Exactly. Interest rates were on the floor. But then suddenly, the Federal Reserve hikes rates aggressively all through 2024 and 2025. That developer hits what the industry calls a refinancing cliff.
Meaning their original loan expires.
Right. Their cheap loan matures. They have to go get a new loan, but the new rate might be double or even triple what they were paying before.
Wow.
And the property's rental income hasn't doubled,
Not at all.
but the mortgage payment just did. So the math simply stops working, properties got foreclosed on, valuations plummeted, and the entire sector just took a massive hit.
But now, here we are in 2026, and the data in the report is presenting a really fascinating reset. The dust is finally starting to settle from those massive defaults.
Which forces every single investor who is looking at these platforms to ask a very critical question.
Are these crowdfunding acts still worth the risk for you?
Exactly. And to illustrate just how high the stakes are when you're deciding between these platforms, the analysis uses this highly specific hypothetical scenario.
I love this part of the report.
It's so good. Imagine you have exactly $9,847 to invest.
A very specific number.
Very specific. Depending on whether you drop that capital into an automated fund on Fundrise or a direct private placement on RealtyMogul, your money goes on two wildly different journeys.
Completely different paths. You're going to face entirely different tax treatments, entirely different risk profiles, and totally different fee structures.
And those differences fundamentally change the potential growth of that capital over a 10-year horizon.
Okay, let's unpack this, starting with the absolute giant in the room, Fundrise.
The heavy hitter.
Yeah, the report doesn't even just call it a platform. They refer to it as an asset management behemoth. They're the ones who essentially pioneered the right model.
Right.
Can you break down what that actually means for someone putting their money in?
Sure. And a REIT, which stands for Electronic Real Estate Investment Trust, is essentially a massive pooling mechanism. Fundrise takes retail money, your money, my money, the $10 from the guy down the street.
And just piles it all together.
Exactly. They pool it all together, and then they take that massive pile of collective capital and go out and buy huge portfolios of residential and commercial properties.
Which is brilliant, honestly. It allows for fractional ownership at a scale that just was not possible for retail investors 20 years ago.
Not even close to possible.
And what really stands out in the analysis is the sheer frictionless nature of it.
Yeah.
They compare the user experience to something like Betterment or other robo-advisors.
Yeah.
How does that actually look from the investor's side of the screen?
It's designed to be completely hands-off. You do not need to be a real estate mogul. You don't need to know how to swing a hammer or fix a leaky roof.
Thankfully.
Right. You literally just deposit your money and then you select a broad strategic goal.
Like what kind of goals?
So you can pick supplemental income if you want regular dividends. You can go balanced. Or you can choose long-term growth if you are looking for property appreciation over time.
And then what?
Once you make that selection, their algorithm completely takes over. It automatically spreads your capital across dozens, sometimes hundreds of active projects across the entire country.
That tells us exactly who the ideal investor for this platform is. Let's say you have $2,150 sitting in a savings account.
Okay.
You want immediate exposure to a broad swath of Sunbelt residential properties, but you absolutely do not want to underwrite a deal yourself.
That is the perfect use case. Because underwriting a commercial deal yourself is literally a full-time job.
Oh, for sure.
You would have to look at local zoning laws, population migration trends, and you'd have to analyze cap rates.
Okay, wait, cap rates. That is one of those terms that gets thrown around constantly in real estate circles. How should we be thinking about that?
Good question. Think of a capitalization rate, or cap rate, as the natural yield of a property.
The natural yield.
Right. If you bought a building entirely in cash, with no mortgage at all, the cap rate is the percentage of your purchase price that the building would generate in pure profit over one single year.
Okay, let's use some numbers.
Sure. If you buy a $1 million building and it generates $50,000 a year in net income, that is a 5% cap rate.
Got it.
But analyzing whether a 5% cap rate is good or bad for its specific neighborhood in Dallas, that requires intense local knowledge.
Which the average person with a smartphone does not have.
Exactly. So Fundrise's pitch is basically, hey, don't worry about it. Our team and our algorithm will handle the cap rates for you.
It's the ultimate set it and forget it experience. But of course, there's always a trade-off when you hand the keys over to an algorithm.
Always. And what's fascinating here is the sheer lack of control you have as an investor.
You really have none.
None. When you use Fundrise, you are buying into what the industry calls a blind pool fund. You don't get to look at a map and say, I really believe in the location of that specific logistics center in Ohio, put my money there.
You have zero say in the individual assets.
You are blindly trusting the fund managers to make every single call.
Which might be totally fine for someone who wants to be fully passive. But let's talk about the cost of that convenience.
The fees.
Right. The report breaks down the fee structure, noting a baseline 0.15% advisory fee, coupled with a 0.85% asset management fee.
So that's a flat 1% a year.
Wait, 1% total? In the world of mutual funds and ETFs, that is actually pretty high. Why would I pay a 1% management fee when I can go to my normal brokerage account and just buy a Vanguard REIT ETF for a fraction of that cost, like 0.12%?
It's a very fair question, and it really comes down to the difference between public and private markets.
Okay, break that down.
A Vanguard REIT ETF buys shares of publicly traded real estate companies on the stock market. Because they are traded on the stock market, their value fluctuates wildly every single day based on the stock market's overall mood.
Right. It tracks with the broader market panic or greed.
Exactly. It's not necessarily reflecting the actual value of the underlying buildings on a Tuesday at 2 p.m., but Fundrise is buying private real estate.
So it's insulated from the stock ticker.
That's the argument. The argument is that private real estate is less volatile and less correlated with the stock market. But you are paying a premium for that private market access.
Hence the 1%.
Right. But the report highlights a significant catch regarding that 1% fee.
There are hidden fees.
I wouldn't call them hidden, but they are layered.
Layered, okay.
Because you are investing in a massive pool of properties, there are underlying project-level fees attached to the individual real estate deals before your money even reaches the fund level.
Like what?
These might be development fees or property management fees paid to third-party operators. Those underlying fees can sometimes blur the true cost of your investment.
So the 1% isn't the whole story.
Not at all. You might be experiencing a drag on your returns that is significantly higher than that baseline 1% when all is said and done.
That is a crucial detail to keep in mind. So, all right, that is the Fundrise machine. Automated, broad exposure, low barrier to entry, but zero control and layered fees.
Yep, that's the summary.
If handing over the keys to an algorithm makes you nervous, the daily fiscal report points out a completely opposite approach. Let's look at RealtyMogul.
A totally different beast.
They operate with a totally different DNA. Yeah. Now, they do offer public, non-traded REITs, specifically Mogulrite, the 7, Mogulrite 2, but their real standout feature, the thing that really puts them on the map.
Private placements.
Exactly.
Private placements.
And just to define that clearly in this context, a private placement is a standalone commercial deal.
So instead of a massive fund of dozens of properties,
You are looking at one single specific asset.
The report paints a very clear picture of who this is for. This is a playground for the aspiring commercial operator.
Oh, without a doubt.
This is for the investor who wants to intensely and aggressively scrutinize a specific sponsor's track record. You go onto the platform because you want to evaluate the exact debt stack on a specific retail center in Florida. Or you are deciding to buy into a specific 240-unit complex in Texas. You mentioned evaluating the debt stack. That is a perfect example of the level of detail we are talking about here.
I'm glad you caught that because debt stack is definitely heavy industry jargon.
Yeah.
When I'm looking at a single apartment building on RealtyMogul, what am I actually looking for in the debt stack?
You are basically looking at who gets paid first if the property goes belly up.
The worst case scenario.
Right. The debt stack is simply the hierarchy of money in a deal. At the very bottom, you have the senior lender. That is usually a big bank that holds the primary mortgage.
Okay.
They have the lowest risk because they get paid back first no matter what.
Makes sense.
Then you might have mezzanine debt sitting right above that, which is a secondary loan with a higher interest rate.
Right.
And finally, at the very top of the stack is the equity. That is you.
The RealtyMogul investor.
Right. You have the highest potential for profit, but if the building sells for a massive loss, the bank gets made whole first. The mezzanine lender gets made whole second. And your equity might get completely wiped out.
Wow. So underwriting a private placement means understanding exactly how risky your specific position in that stack really is.
Exactly. It's not for the faint of heart.
And speaking of not being for everyone, I know the accredited investor tag gets thrown around a lot in private equity as a requirement for these types of deals.
It's the ultimate gatekeeper.
What does the SEC actually require you to prove before you can even look at these specific RealtyMogul private placements?
It is a strict financial threshold. Regulators set it to ensure you can theoretically afford to lose the money you are investing.
Because the risk is so high.
Right. To be an accredited investor, you generally need to prove you earn over $200,000 annually. Or you need to hold a net worth of over $1 million.
And there's a catch there, right?
A big one. That $1 million net worth strictly excludes the value of your primary residence.
So your house doesn't count.
Nope. So, right out of the gate, this cuts out a massive portion of everyday retail investors.
It is definitely not the $10 tap your smartphone crowd anymore.
Not at all.
The report notes that to really play in this space, you need something like $35,000 in dry powder.
And dry powder simply refers to highly liquid cash reserves, money you have sitting on the sidelines, totally unencumbered, ready to be deployed into an investment immediately.
And it's not just the money, it's the time commitment. The analysis points out that RealtyMogul's private placements are for someone who actually enjoys sitting down and reading an 80-page private placement memorandum on a Sunday afternoon.
The infamous PPM. Yeah, it demands an intense amount of attention. You are reading that 80-page legal document, not just to understand the property itself, but to understand how you're going to get charged.
Because the fees are different here, too.
Very different. The fee structure on RealtyMogul varies aggressively on a deal-by-deal basis. You aren't just looking at a flat 1% platform fee like Fundrise.
So what are we looking at?
The data shows administrative fees around 1.25%.
Yeah.
And those are then paired with highly complex promote structures.
Okay, a promote structure. I hear that phrase a lot when people talk about real estate syndications. But how does that actually hit my wallet in a real-world deal?
Let's use some hard numbers to make it crystal clear.
Let's do it.
A promote structure basically dictates how the profits are split between you, the passive investor, and the sponsor.
And the sponsor is the team actually finding the building and doing the renovations.
Right, they do the heavy lifting. So a very common structure on these deals is an 8% hurdle rate with a 20% promote.
Okay, walk me through the math on that.
Say you invest $100,000 into a deal.
Got my 100 grand in.
The hurdle rate means the sponsor has to deliver an 8% return to you first.
So $8,000 of profit.
Entirely to you. They do not get a performance bonus until you hit that hurdle.
That sounds great.
It is. But once the deal makes more than that 8%, the promote kicks in.
Okay.
For every dollar of profit above that 8% hurdle, the sponsor suddenly takes a 20% cut of the upside, and you get the remaining 80%.
Okay, so they get rewarded for outperforming.
Exactly. It's designed to align their incentives with your own. It rewards them for knocking the investment out of the park. But it requires you to model out the math before you invest.
Because if you just click invest blindly on a private placement without understanding the promoter,
You are doing yourself a massive disservice.
here's where it gets really interesting, though.
Oh, yeah.
We've talked about how easy it is to put your money into the automated Fundrise machine. And we've talked about the intense scrutiny needed to put your money into a RealtyMogul private deal. What happens when you want your money back?
The ultimate question.
The daily Fiscal issues a critical, extremely blunt warning about what they call the liquidity illusion.
It's the most important part of the report.
Listeners, if you are hearing this right now and you think you might need your invested money back in 3 years, do not use either of these platforms. Full stop.
It is the harsh reality of the asset class. Real estate is fundamentally illiquid.
You can't just sell a building on a Tuesday.
Exactly. You cannot instantly sell a 240-unit apartment complex in Texas the way you can sell a share of Apple stock on an exchange. Therefore, this is absolutely not the place to park your emergency cash.
But don't both these platforms heavily market these supposedly easy redemption programs? I've seen the ads where they claim you can cash out on a quarterly basis.
They do market that heavily, and frankly, that marketing can be very misleading if you don't read the fine print.
What's the catch?
They theoretically allow you to request your cash quarterly, but what is deeply buried in the legal disclosures is that these redemption programs are completely discretionary.
If we connect this to the bigger picture, we just have to look back at the recent market freeze we talked about earlier.
The 2024 shock.
Right. When the commercial real estate market seized up during that interest rate shock, these platforms exercised their legal right to pause redemptions.
They pulled the emergency brake. And they did it to protect the asset base from a bank run scenario.
What does that actually look like for the investor when the brake gets pulled? If I go into my app and I hit withdraw, what happens to my money?
You get an email, and it basically says, your request has been denied or placed in a queue indefinitely.
So your principal's just trapped.
Trapped. You might still receive some quarterly dividend payments if the buildings are still generating rental income, but you cannot access your core capital.
That is terrifying.
It is. But from the platform's perspective, they have to do this. Think about it. If everyone panics and asks for their money back at the exact same time, the platform doesn't have the cash just sitting in a vault.
Right, the cash is in the buildings.
Exactly. They would be forced to sell off the underlying buildings in the real world to get the cash. And selling a massive commercial property in 30 days is a fire sale.
They get crushed on the price.
They might have to take a 30 or 40% loss on the value of the building just to generate the cash to pay off the exiting investors. That destroys the value of the fund for everyone who decided to stay.
So to prevent that death spiral, they just stop all withdrawals.
Exactly.
Let's look at how the two specific platforms handle this legally, because the mechanisms are slightly different between the two.
With Fundrise, they offer quarterly redemptions, but they slap you with penalties if you try to pull your money out within the first 5 years.
Ouch.
But here is the real kicker. Even if you are willing to pay the penalty, the ability to withdraw is completely at the sponsor's discretion. The board can simply vote to suspend redemptions, which they historically have done during periods of stress.
And on the RealtyMogul side?
For their non-traded REITs, they also claim a quarterly redemption policy, but the reality there is rigidly capped by a mathematical formula.
How does the formula work?
They generally will only allow total platform withdrawals up to a very small percentage of the net asset value, or NAV, per quarter.
Like how small?
Often just 1.25% or 3% of the total fund.
Wow.
So if thousands of investors all rush the exit at once and the requests exceed that tiny percentage cap, you are stuck waiting until the next quarter, where you have to try again.
So the illusion of liquidity is just totally shattered the moment the market faces severe stress.
Completely shattered.
So what does this all mean for you? We've covered the automated machines, the private deals, the layers of fees, and the harsh reality of trapped capital.
It's a lot to process.
It is. But the daily Fiscal doesn't just leave us with problems. They actually outline a highly practical, three-step action plan for anyone listening who is considering diving into this space. We want to walk you through this before you transfer a single dollar.
It's a great checklist.
Step 1. Strictly audit your liquidity timeline.
Based on the fundamental illiquidity we just discussed, the rule from the text is incredibly clear here. Do not invest any capital into these platforms that you might realistically need before the year 2031.
5 years from now.
You need a rock-solid 5-year minimum time horizon. Real estate business plans, buying a property, renovating it, raising the rents, and selling it take years to play out.
Right.
If there's even a small chance you need that cash for a down payment on a house, a medical emergency, or a wedding in the next 3 or 4 years, you are taking on massive opportunity cost. Keep that money in a liquid, high-yield savings account, not in private real estate.
Perfect. Step 2. Review your accreditation. This basically acts as a filter for your options, right?
It's a simple binary check. Do you make over $200K a year, or do you have $1 million net worth outside your house?
Yes or no?
If the answer is no, then your decision is largely made for you. Direct private investments on RealtyMogul are legally off the table. That regulatory barrier naturally pushes you toward the right model anyway, whether that's RealtyMogul's public REITs or the automated Fundrise machine.
And finally, step 3. Compare those fee schedules. The analysis gives a fantastic, super practical 15-minute hack for this.
It is the highest return on investment you will ever get for 15 minutes of your time.
Tell them what to do.
Before you invest in any non-traded REIT, open up the legal document called the offering circular. Do not read the marketing brochure.
Skip the glossy photos.
Read the offering circular. Hit Control F on your keyboard or use the search function on your phone and search for the exact word fees.
And read every single hit.
Read every single hit that comes up.
You're looking for the management fees, the administrative fees, and those underlying project-level developer fees you mentioned earlier.
Yeah.
You have to know exactly who is getting paid with your money before the property even generates a single dime of profit.
It changes everything when you see it laid out like that.
When we look at the final verdict from analyzing over 45 different deals, the lines are drawn pretty clearly. Fundrise easily takes the crown if you want total passive, hands-off diversification.
It is a brilliant piece of technology for spreading small amounts of capital across massive portfolios without doing any of the heavy lifting.
Conversely, RealtyMogul is the undisputed winner if you have the capital, the credited status, and the intense desire to underwrite individual commercial properties.
It offers premium, specific deal flow for people who want to act like real commercial operators.
It really is incredible how technology has completely bifurcated the way we can interact with real estate. You can be a passive observer or a granular operator, all from the exact same device.
It is incredible. But this raises an important question, and it's something I really want you to think about long after this deep dive ends.
Lay it on us.
We started by celebrating the fact that technology has completely destroyed the country club barrier. It reduced the cost of entry down to a mere $10 tap on a smartphone screen.
The ultimate democratization.
Right. But think back to the liquidity illusion we discussed. If a simple automated algorithm can instantly lock up your funds during a market panic, specifically to prevent a bank run scenario and protect the overall portfolio, who really holds the power in this modern era of democratized finance?
Oh, no, that's heavy.
Is it the everyday investor who finally got a seat at the table?
Right.
Or is it the code dictating the fine print, deciding when and if you can actually touch your own money?
Wow. That is an absolutely brilliant point to end on. The barrier to entry might be gone, but the exit door is still guarded by the algorithm. Thank you so much for exploring this deep dive with us today. We hope this gives you exactly what you need to navigate the new world of private real estate. Catch you next time.